I guess here are the exam one review questions. I'm going to go through them and just walk through each one, how I would do them. I mean, there's more than one way to do these problems. Um, don't just, I'd recommend, don't just look at the answer and then try to back into the answer. That will make kind of superficial sense if you do it that way. But when I change up test, obviously you won't have the answer at that point in time. And so to back into it won't work, right? Um, yeah, I want you to be able to think through these problems, logic through them. Not necessarily, you don't have to memorize a lot, I don't think, for this test, hopefully. But instead, if you can just understand fundamentally what's going on, then you should be good to go. So let's just keep going. So probably the first two things I would do when I got the test, I guess it'd be a paper test. L R C, right? And remember, these are debits, these are credits. So just to kind of remind yourself, okay, assets, expenses, and debt and dividends all have debit balances, and liabilities, revenues, common stock all have credit balances. And then we have the accounting equation: assets equals liabilities plus equity. Remember, these four accounts here, those four accounts there are all considered equity accounts, right? So expenses, dividends, revenues, common stock are all equity. Okay, cool. So let's look through this. So this company has performed cleaning services for a department store on account for $180. How would this transaction affect global cleaning supplies, services, whatever, global cleaning services accounting equation? Okay, so we've performed work, right? And we've done it on account. Okay, so our assets are going to go up. That's our accounts receivable account, would be considered an asset. And then the account that explains that is an equity account going up, and that's revenue, right? Our revenue is going up. So if we did the journal entry for that, we would debit accounts receivable and credit revenue, and it'd be for the 180 bucks. Okay, so we didn't actually receive cash, but we did perform the work, and that's that revenue account there. And then accounts receivable is a resource, it's an asset. It's showing that they owe us that money. Okay, so that's basically how you do it. Now we just, like you notice, I didn't look and see, I didn't read through the answers first. I don't like to do that. I think you can get confused by that. Instead, go through and look now that we have it and see increase both assets, liabilities, no. We don't owe them anything. Increase both assets and equity 180. So the correct answer is D. Just 1 second. Okay, let's move on to the next one. And don't ever hesitate to speed up these videos or skip different parts. I mean, if you know how to do something, don't just waste your life away watching. Also, I just thought of another thing on the test. So the majority, well, the first question, it's actually similar to this, honestly. First questions are multiple choice. And then at the end of the test, you'll have a number of journal entries that you'll need to prepare. Make sure, oh yeah, the points are worth different amounts, but make sure and do how it impacts the accounting equation, and then also provide the journal entry. So there's two parts. but I clarified that in the test. So, okay, now just kind of a sorry, the conceptual question here. Which of the following accounts as a liability? Remember, a liability, this part here, is an obligation of the business, something that we owe to someone else. Okay, so anytime we do work or provide a service, that's never going to be a liability, right? Because we're doing the work. Instead, a liability would occur if someone pays us early and we haven't done the work yet, or if we borrow money from someone or some entity, or if we buy on account, right? So those are kind of the things that we're looking for. And so we look down through this accounts receivable. We just finished up saying that was a resource, right? Someone owes us. Service revenue, that's the concept of doing work. We perform work, same kind of previous question. And then unearned revenue. That one there is where we receive cash early. So we've received cash. Let's say your grandma wants you to mow her lawn for the whole summer, and she pays you in the beginning of summer. So let's say she pays you $500 or something. Okay. Well, you've received cash, but have you done any work? You haven't yet, right? Like you'll start to mow the lawns during the summer. And so the credit is going to be to unearned revenue. Okay. And that there is a liability account. So do you see how your cash would be going up and your liabilities would also be going up? Okay. So that's how those problems work, and it'd be $500. Okay. So the liability account there is unearned revenue. It's also called deferred revenue, or you can just simply label it as a liability. And then prepaid expenses, that's where you pay early. Okay, so prepaid expense would be like you pay for your rent early. So you pay for the full year or something. So you would credit cash, and in return, you're receiving another type of asset, which is prepaid rent. You have that resource that's available to you as a business or as an individual for the full year. And that's why it's an asset and it's not actually an expense like an equity account expense. It's an actual asset. Okay. So then salaries payable account. Okay. So salaries payable. Okay. So this is where people have performed work for us, but we haven't paid them yet. Right. And so like they've done work, we just haven't paid them yet. And so that's a liability account. We have that obligation. And remember, liability accounts have normal credit balances. That's your credit balance. And so we need to go find something. So liability account with a normal debit balance, nope. So go drop down to C, liability account with normal credit balance. So the correct answer. So you really just need to know, it would be good. Maybe I'll do a separate video, like try to name off every asset account that you should kind of know, every liability account you should know, and then every equity account you should know. That might be a good video to do. Because that's one of the most challenging parts for students, is just knowing what account is what. Okay, your business purchase office supplies, $2,500 on account. Journal entry to record this transaction is as follows. Okay, so it doesn't ask you to analyze it, but I mean that's really what you're doing, right? So assets equals liabilities plus equity, and then you're thinking to yourself, okay, so we purchased office supplies. Office supplies are an asset, right? They have value to the business going into the future. So we purchased those things, but it says we did it on account. So that means we didn't pay for them right away. And so we have a liability, an obligation that is also going up. So now let's see if we can find that concept. So our assets are going up, office supplies, and then accounts payable. So that looks great. Let's look through these others and understand why they're not right. So office supplies, that part is correct, but accounts receivable is going down. Okay, remember accounts receivable is an asset, but we're crediting that account, so it would be going down. That doesn't really make sense. That would mean that someone would owe us, well, but they would owe us less because it's going down. Okay, cash is going up. It doesn't make any sense, right? Accounts payable is going up. That part of it makes sense, but the cash part doesn't. And then accounts payable going up. Or sorry, it's a liability account, so accounts payable would be going down. That doesn't make any sense. Office supplies are going down. Also doesn't make any sense. Good. All right. Keep going here. Explain how the following journal entry would affect the accounting equation. Okay, so equipment is being debited. Okay, equipment is an asset account. So when we debit that account, it goes up. And then accounts payable, remember that's a liability account, and we're crediting it, so it's going up also. And so our assets are going up, and our liabilities are also. Assets would increase, and oop, that's not right. Liabilities would increase. There we go, and assets would increase. So D's the correct answer. Okay, again, I don't like to read through those answers before I think through it, because when you start reading through that, you can kind of start to get confused. You get mixed up on this. Okay. For revenues, category of account and its normal balance is, okay, so revenues, remember, that's one of your 4 equity accounts, okay, and it has a normal credit balance. So for revenues, category of account, its normal balance is equity and has a credit balance. Which of the following accounts would normally have a debit balance? Okay, so our normal debit balance are assets, expenses, and dividends. Let's see if any of those are in here. We normally have debit balance. So accounts payable, that's a liability. Accumulated depreciation, that's a contra asset. That's something we haven't talked about yet, so don't worry about it. Prepaid insurance, there you go, that one there. Prepaid insurance is an asset. It's a resource to the business. It means we don't have to pay insurance into the future because we paid it early. And then common stock is an equity, so that would have a credit balance. So really, those other 3 have credit balances. This is the only one here that has a debit balance. Okay. Okay, next problem. Number 8. Following transactions for the month of March have been journalized and posted to the proper accounts. Okay, so the journal entries have been done and it's been posted to the T accounts. So now it just wants to know, so I'm going to skip all this information here and just jump down, find out what it's actually asking. So it's asking what the cash balance is. So I just want to think through this and say, okay, of these transactions, what increases cash and what decreases cash? We can put it into a T account. I probably honestly wouldn't. I would just do pluses and minuses, but we'll do a T account just to show you how that works. Okay, so we have the cash, T account, and then the business received $9,000 cash. So that would be a debit. Increase our cash account. Paid first month rent, $900. That's cash going out. So that would credit that account. Purchased equipment, paying $3,000 cash. So that would be cash going out. So it'd be credit. The rest of it is a note, so it's not involved. Purchase office supplies for $730 cash. It's going to decrease cash. And then build a client $10,000. Design services complete. So we build them, but the issue is, and this is the key, like, don't get ahead of yourself, right? So just because we build them doesn't mean they actually paid us. And so don't do anything there. That doesn't impact cash. And then received $7,900 on account. So there we received cash. So that's going to increase our cash. Now all you have to do is just sum these up real quick, right? So just go 9,000 plus 7,900, and then subtract off all of those credits. So minus 900, minus 3,000, minus 730, so 12,000. So we have a 12,270, and obviously it's a debit balance because that's a normal balance for cash, which is an asset account. So 12,270. So the correct answer is B. Okay, next one, another one with a lot of information. So skip that. Let's just see. So at the end of the month, all journal entries are posted ledger. Accounts receivable will appear as which of the following. Okay, so now instead of focusing on the cash account, we're focusing on a different type of asset account, accounts receivable. Okay, so again, it's going to have a normal debit balance. So actually, right off the bat, like that has a credit balance, you know it's not that one. That has a credit balance, you know it's not that one. So it's either C or D right off the bat, but you don't want to leave it to 50% chance. Is it the exact same information? Nope, it's not. Okay, so we got to read through it. So received $25,000 cash, common stock. Okay, so that doesn't impact accounts receivable. Purchased office supplies on account. That would be accounts payable. Okay, that's a liability account. Here we're talking an asset account. This one is when we do work or sell something on account. Accounts payable is when you buy something on account. Okay. Purchases $4,000 furniture on account. Nope, that's accounts payable. Here we go. So we render service to various clients totaling $17,000 on account. Okay, so it's going to increase our accounts receivable account. Okay, remember that journal entry would be debit, accounts receivable, credit, revenue, $17,000. Okay. Business pays $2,000 for salary expense. Okay, so nothing there is related to accounts receivable. Business pays $800 to a supplier. Again, that's related to things that we purchased, not that we sold. And then the business collects $3,000 from one of its clients for services rendered earlier in the month. Okay, so now they're paying us. So think of the journal entry. It would be debit cash, cash of $3,000. But now they don't owe us, and so we've reduced down our accounts receivable. Okay, and so that's going to credit accounts receivable. And so then you just go 17 minus 3,000 gives you 14,000. That's the answer. Cool. Hopefully that makes sense. And what I would recommend on these problems is go through. So we've done it for cash now. We've done it for accounts receivable, but you could also do it for accounts payable. Do a T account for accounts payable. Remember, that'll have a normal credit balance. You can go through and do this whole thing based on it being accounts payable. Just practice it. Okay, so using the following accounts, their balances, prepare a trial balance for Bob's Donuts. Select the total amount for debits and credits. All accounts have normal balance. Okay, sweet. This one actually is a good one to show you like which ones are assets, which ones are liabilities, which are equity. Okay, so cash is an asset, so as a normal debit balance. Unearned revenue is a liability. Remember, that's where we've received cash early, but we haven't done the work. Okay, so that has a normal credit balance. Actually, the other thing that would be nice is go AEDLRC. So just rewrite that. Go to your debits. These are your credits. Okay, because I mean that's really what you're doing on this problem. Okay, so unearned revenue, the liability, so it has a credit balance.
Equipment is an asset account, right? That's value to the business. Resource the business has available to it. Service revenue. Revenue is a credit balance. Okay. Common stock has a credit balance. Common stock, credit balance. Advertising expense right here has a debit balance. Utilities expense has a debit balance. Rent expense has a debit balance. Those are all expenses. Accounts payable is a liability. We owe that money to someone. We have to pay it to someone. So that's a liability. So I have a credit balance. And then dividends have a debit balance. Okay. So now just choose one of these to sum up, either sum up all the debits or sum up all the credits. Whatever number that is will be the right answer. You can double check and make sure it should always equal each other, right? So I'm just going to go debits first. So 14,000. Writing's not very good, is it? What is a debit? Okay, so 14,000 plus 11,000. Oops. Plus 11,000 plus 1600 plus 1100 plus 4,800 plus 6,750. Did I get an answer that's here? So 39,250. So that should be that one there, just for fun. Would I do this necessarily on the test? I don't know, probably not. Maybe depends on how nervous I was about it. But now I'm going to go through and do the credits real quick. So 9,250 plus 12,000 plus, I get that 9,250 plus 12,000 plus 16,000 plus 2,000 or 9,250. Cool. So that's definitely the correct answer. B. Okay, Caleb Brown has been the sole owner of a bicycle sales and repair shop for several years. Which of the following types would limit Caleb's personal liability exposure to the business? Okay, so remember, sole proprietor basically makes him the same as the business. Okay, so that's not good. But a limited liability company would provide that protection for the owner. Now, the reason it's not limited liability partnership is because he's the sole owner, right? He doesn't have any partners. Okay. Now, if one of the answers was corporation, that would also limit his liability, is the exposure, and so that could be an answer to the corporation. That's the only second liability company. Okay. 10 years ago, a corporation purchased a building for $160,000. Okay, so let's just jump down. So which amount should the corporation record the building in its accounting records? Okay, so this is what's called the cost principle. Okay, it just means whatever we purchase something for, that is what we record it for in our accounting records. Like that's what we do the journal entry. So really, right off the bat, we purchased the building for $160,000. That's what we should record it in our accounting records as. So that's the correct answer, but we'll read through it, just be careful. At that time, the corporation felt the business. I don't know what business. I would imagine that's a typo, should be building. Okay, so they felt like it was worth more. That doesn't matter. You don't record it for what you think it's worth. You record it for what it's worth. Now, the current market value of the business, why is it saying business? Should be building. Is $460,000. Building has been assessed for $435,000. Okay, So from a financial accounting perspective, we don't mark these assets up to their current fair values. We just focus on what the cost was. And so that's $160,000. Yeah. Oh, hey, check this out. This one here, calculating return on assets. Actually, that isn't, I mean, return on assets is definitely a ratio that is important, but for this class, the new textbook that we're using, it doesn't do any ratios. And so even though you guys are using other textbooks that may focus on ratios, textbook for this class doesn't. And so don't worry about that one. I'll double check on the test to make sure that we don't have one doing ratios. Okay, so for the full class, you don't have to do any ratios. So that's good news. What business event is presented by the journal entry? Supplies, accounts payable. Okay, so our supplies are going up. It's an asset of the company, right? They'll be able to use those supplies in the future. And then accounts payable, so that means we purchased them on account. We didn't pay for them. And so our liabilities would also be going up. So we didn't incur an expense, right? Because we didn't consume the supplies. We're increasing the supplies. We didn't use the supplies. That would actually be the same thing. Purchase supplies with cash. Nope, we purchase supplies on account. Okay, York Casting Services started the year with total assets 110,000, total liabilities 50,000, revenues expenses for the year amounted to blah blah blah. I'll come back to that. I want to find out what the actual question is asking. During the year, company did not issue common stock but distribute dividends. Calculate the amount of increase or decrease in stockholders' equity. Okay, because so it's not asking for the total amount on this question. It's just asking for the change. And remember, equity is really only changed by 4 things. Okay, so the equity account is increased by revenue and common stock, and it's decreased by expenses and dividends. Okay, and it's only asking for the change, right? Therefore, we don't need to focus on what our total assets and liabilities were. All we need to do is focus on what increased equity and what decreased equity. So so revenues were 140. That increased, right? So that's positive. Expenses were 50. That's going to be a decrease. And then we didn't issue any common stock, so obviously we don't need to worry about that one. And we did distribute dividends. Dividends decrease equity 70. Okay, so we just need to do that math real quick. So 140 minus 50 minus 70. And so the change was an increase of 20,000. Okay. Now be careful, if the question asks what is the balance, okay, then at that point we have to go, our assets in the beginning were 110. Our liabilities were 50. Okay. And so therefore our equity, we can solve for that unknown, would be 50, 60,000. Okay. See how that balances? Like 110 equals 50 plus 60. Okay. So at that point, that would be like our accounting equation. And then because it increased by 20,000, 60, 70, 80. So our new equity balance would be $80,000. Okay. But that's not what it's asking. It's just asking for the change. Okay. 16. Sorry, if you want to move along here. It's not really, I don't know what time it says on this thing, but that's not the, well, actually, anyway. Okay, next one. Blank is the equity earned by profitable operations that are not distributed to stockholders. Okay, that's our retained earnings. Okay, so that's what we retain within the business. We don't distribute it through, remember, we distribute excess earnings through dividends. And so the portion of our earnings that isn't distributed is called the retained earnings. Okay, we'll get more into that in the future. Okay, next one. Pitch Supply Services received $1,000 cash from customer. The amount was owed to the business from previous month. What is effective transaction? Just a second. I don't know. People are starting to wake up. I think I'm gonna pause here for a second. Okay. Let's get back to this. I've moved to a different room. So, at that point, it go up, right? That's an asset going up, and they don't owe us money anymore, right? See, so in the previous period or whatever, our accounts receivable would have went up, and our service revenue would have also went up, right? Well, now they don't owe us anymore, and so because they're paying us cash, our accounts receivable is going down, which that's an asset account. So our assets are going up, but our assets are also going down. So let's see here. So accounts receivable increases, no. Cash increases, yes. Accounts receivable decreases, so B is the correct answer. Okay. Don't hesitate. If I'm not explaining things, just shoot me an email or a text or something. Say, hey, go over this a little better. I'm happy to. And again, speed them up if they're easy for you, or if you kind of understand it. Okay. Net income of Edwards Corporation amounted to $73,000 for this year. Beginning balance of stockholders' equity was $30,000. Ending balance was $70,000. Company issued no common stock during the year. What was the amount of dividends distributed during the year? Okay, so this one is just looking at accounts that impact equity, right? So your four equity accounts are expenses, dividends, so they both have debit balances, and then revenue and common stock. Okay, these two increase equity, these two decrease equity. Okay, so okay, so we had net income of $73,000. Okay, net income is simply revenue minus expenses. Okay, so that's already netting that out. Okay, so that's the first part of it. Beginning balance of stockholders' equity was $30,000. Ending was $70,000. Okay, and they didn't issue any common stock. Okay, so if we look at this, we have a beginning balance of 30, and then if you put it into an equation, so over here ending, and that is 70. Okay, so our beginning is 70. Remember, revenue would increase it. Okay, they said it didn't issue any common stock, so we didn't have anything there. So revenue would increase it, expenses would decrease it. So beginning plus revenue minus expenses minus dividends, and then that'd give us our ending balance. Well, these two are already collapsed into one. So go 30 plus net income. So 30 plus 73 minus dividends equals 70. Okay, so at this point, you're just solving for the dividends. So that'd be 103. And so 103 minus X equals 70. So must be 33. Okay, so we paid out $33,000 in dividends. So, because remember, the only two ways to decrease equity is through expenses or dividends. Okay, we already took into account expenses with our net income. And so dividends are the only other way to decrease it. And then the only two ways to increase it are revenue and common stock. It said there was no common stock issued, and the revenue was part of this 73,000 number. So 33 is the answer. Okay. Oops. Get rid of all this stuff. Do the next one here. Yeah, get rid of all this too. Okay, next one. Dividends is a, oh, well, we just had this, right? So dividends is an equity account, and it has a normal, so think about it. So A, E, and so dividends have a normal debit balance. It's a liability, equity, revenues. Okay, so revenues increase. Equity, right? So we know that those two revenues increase equity, and it has a normal credit balance. So here it is right here. It's one of the two ways to increase. Correct answer is D. This candle company received $40,000 and issued common stock. Which of the following accounts will be debited? Okay, so we're receiving cash. That's going up 40,000. And then we're crediting common stock. We issued stock 40,000. And so the correct answer on that is cash is debited. All right. If you look at the accounting equation on this one, cash is going up and equity is also going up. A business borrows cash by signing a note payable, which the following accounts is credited. Okay, so in this case, assets are going up, we're receiving cash. However, we owe this money to a bank, right? We have to pay it back. And so our liabilities are also going up. So think about it, we're receiving cash, and in order to increase the liability account, we credit that account. Okay. And it says it's a note. And so notes payable is the liability. It's going up. Next one, which of the following statements is true of the common stock account? Common stock is an equity account, and it has a normal credit balance. So it's an equity account that has a normal credit balance. Okay. Accounts payable account of Golden Ink has the following postings. Calculate the ending balance. Okay, so accounts payable is a liability account, so it has a normal credit balance. So we know that ultimately the answer is going to be over here on the right side. So start on this right side, go 29 plus 12, and then subtract off the debits. So minus 18 minus 5. So that gives you a credit balance of 18,000. Okay, so you've got to know the normal credit balance, or you got to know the accounts payable is a liability, and that has no normal credit balance. Okay, the rest of these are the journal entries. So what you'll do on the test is you will write out, you'll say assets. Well, honestly, you're going to be typing. So what you'll end up doing, essentially you're going to be doing this, but you're going to have to type it out. So you're going to say, so for example, on this one, business receives $25,000 cash, issues common stock. Okay, so you're going to say assets increase and common stock increases. And you can abbreviate things. So assets increase, common stock increase. And then you also, so that's part one, okay, is the impact on the accounting equation. Part two is the journal entry. And so for this one, you can go type in cash, 25,000, and then just indent or slide over, and then, or you could just say credit or common stock, $25,000. Okay.
So anyways, just make sure you show, I think it'll allow you to indent in the answer, and then you can just type that in. I think all of these, we have done in that PowerPoint. Okay. The only one, I think we did that. Yeah. So all of these we've done. I think I showed the answers to them. Well, actually, obviously I don't. So, what I probably better do is, well, I'll just go through and do them. That's the easiest way. Okay. So business purchases $800 of office supplies on account. Okay. So our assets increase, and you can abbreviate, right? So assets increase because we have office supplies. And then it's on account. So our liabilities also increase. Okay. And then the journal entry would be debit office supplies 100 and credit accounts payable 800. Okay. So that would be the answer, and that would be full credit. And just know these are worth, can't remember exactly how much they're worth. It'll say on the test. They're worth quite a bit. So make sure you can do these journal entries. Okay. Business purchases, and do all the ones in the PowerPoint to just make sure you've done a lot of these to practice. Okay. Business purchases, $4,000 furniture on account. So I'm just going to abbreviate from now on. Asset increase, it's on account, so liability increase. You can totally do it this way too on the test. Just put a plus sign next to, because all you're really doing is assets, liabilities, equity. So you're just showing which of these is increasing or decreasing or whatever. Okay. And so furniture is what we're debiting, and we're crediting accounts payable. I'm abbreviating that one, 4,000. So make sure and put in the amounts, put in, show that this is on the left. See how it's on the left? That means it's being debited. And then this accounts payable is on the, it's indented in, it's on the right. So it's showing that it's credited. Okay. Here we're doing work. Okay. It's on account. So they actually haven't paid us. So it's just accounts receivable, but it's an asset. So assets are increasing and equity is also increasing, right? So we'd have accounts receivable, 17,000, and then credit revenue. I'm just going to abbreviate to say revenue. You could say service revenue if you want, but 17,000. Okay. Business pays $2,000 for salaries expense. Okay. So think about that. So our cash is going down. So negative cash. And then the account that it is explaining that would be our equity. It would also be going down. Okay. And so our cash is going down. 2,000. We want to credit that account. And then that, you know, one of the two ways to show that equity is going down is an expense, and it has a normal debit balance. So you can just go expense, you can say salaries expense, $2,000. Okay. So that's where, if you have this written out, value of that showing like, okay, an expense has a normal debit balance. So I debit that account to increase the expense. And it's one of the two ways to decrease equity. So, but don't put equity plus, right? Because that's not right. It's decreasing equity. Okay. It is increasing expenses. Technically, if you put expense positive, I would probably give that to you because you are increasing your expenses. We debit expense count to increase it. But really, the accounting equation is we're decreasing assets and decreasing equity. Okay. It's just tough. You can't really show that in the test. You're going to have to type it out. Okay, business pays $800 to supplier for office supplies purchased earlier. Okay, so if we're paying and our assets are going down, right? We're paying $800 and we purchased them earlier. We purchased them on account, right? I mean, here, right up here, supplies on account. So remember at that time, our liabilities increased. Well, if we're paying now, then our liabilities are decreasing. We don't owe them that money anymore. So our assets are going down, our liabilities are going down. So we need to credit cash to show it going down, $800. And then we need to debit. Remember, your debits are always come first, even if you write them second. We need to say accounts payable decrease by 800. So you debit that liability account. See how it's normally a credit balance right here? We're going to debit it to get it to go down. So that's how that works. Okay, business collects $3,000 from one of its clients for services rendered earlier in the month. Okay, so now we're collecting money. So our assets are going up. Okay, and we already performed the service, so we would have recorded accounts receivable at that time. So our assets are actually going down too, right? Because that accounts receivable account would go down and we'd record cash. So you debit cash, 3,000, credit, okay? Get that asset account to go down. We credit it $3,000 because we've collected it now, okay? See, we rendered the service. So the service revenue was recorded earlier in the month. Now we're just dealing with the cash part of it. Okay, so that's all of that. Hopefully I didn't rush through that too much. Hopefully I didn't take too long. Remember, don't hesitate to speed things up or slow them down or pause it or whatever, but I appreciate all your work. Hopefully you guys are getting it down. So have a nice day.